So I want to thank everyone for joining today's cryptocurrency webinar. My name is Caitlin Thompson, and I am the VP of Product Strategy here at Evolve. I am joined today by Elliot Johnson, who is our CIO and COO. He's also our resident crypto expert. We've been having a lot more conversations recently with advisors and investors on cryptocurrency, and this is really as adoption continues to accelerate. So today we thought we would take a little bit of a different approach to our traditional webinars, and we would structure it a little bit more as a discussion between Elliot and myself. I'm going to be asking Elliot a number of questions that we get asked most frequently from different investors and advisors. If you do have any questions beyond the ones that I'm going to ask Elliot, please feel free to ask them in the chat box, or I believe there's a feature on WebEx where you can raise your hand as well. And we will get to them at the end of the presentation. The webinar should last around 40 minutes, is the time we're kind of aiming for. So before we jump into the discussion, I thought I would spend a couple minutes either introducing Evolve for some investors or providing a quick update of Evolve. So we launched our first ETFs about 4.5 years ago, and we currently manage over $2 billion in AUM. We have a total of 22 ETFs on our product shelf right now. When we think about our products, we often bucket them into 4 categories, which you'll see on the slide. We have built a bit of a reputation for ourselves around disruptive innovation. It's kind of the first bucket you see there. So we actually launched the world's first automotive innovation ETF, which is ticker CARS. We launched Canada's first cybersecurity ETF, which is the ticker Cyber. We also have an e-gaming ETF, Hero, cloud computing ETF, Data, a metaverse ETF, ticker Mesh. And then Edge there, I'll point out as well, is our broad innovation ETF that gives you exposure to 8 different themes, different disruptive themes, I should say. The next bucket there is our equity income bucket. So there we typically target specific sectors. To name a few on the screen, Life, which targets global healthcare, or Base, the materials and mining sector. Bank, as an example, targets Canadian financials. And then we will layer on an actively managed covered call strategy on up to 33% of the portfolio. So this will allow us to target about a 7% distribution. And we've been gaining a lot more traction on these products lately as investors are looking for new ways to generate income. We also have a number of crypto ETFs, which we'll get into a lot more in this presentation. And then finally, the last bucket I'll touch on is our fixed income bucket, which actually does make up about 40% of our assets as of the end of April. We use 2 exceptional sub-advisors to manage a couple of our fixed income products. Elliots Global Investors manages global bonds for us, and Addenda Capital manages Canadian bonds and preferred shares. And we also have a high interest savings fund, which is very relevant today in these volatile markets. Here's just a little slide to touch on some of the performance that we're really proud of. Edge, as I mentioned, is our global innovation fund, and it's actually won a number of awards for top performance over 3 years in the global equity category specifically. So now jumping into the cryptocurrency webinar. So Evolve has been a leader in crypto since the company's inception. Elliot, I was wondering if you could expand a little bit more on Evolve's early interest in the space and how that's translated into launching some of the first crypto ETFs in Canada.
Yeah, thanks very much, Kate. Nice to meet everybody today. We've been looking at cryptocurrencies since we launched our business. As the name of our business implies, we're obviously always looking for where the world is going. And that's why our brand is really associated with disruptive innovation. So digital finance and decentralized finance is right at the core of our mission to bring innovative investments to investors. And so back in 2017, we were actually the first Canadian issuer to file a prospectus for a Bitcoin ETF. At the time, we were going to use a futures contract because we thought we could make that work from an operational perspective, but the regulators weren't ready yet. So we were working on cryptocurrency ETFs for 4 years before we managed to launch EBIT, the Bitcoin ETF here on the top left, back in February of last year. And we followed that up a couple of months later with Ether, our Ether ETF. And then last fall, we launched ETC, which holds both of those other ETFs in their cap-weighted relative weight. So it's a single ticket solution for people who want access to both. And ETC in the future will add other cryptocurrency ETFs as we're able to bring more to market. And really, the difference between 2017 and 2021 was the build out of the cryptocurrency industry and the infrastructure that provided the ability for us to do physical cryptocurrency ETFs. So in both cases here, EBIT and Ether, they actually own the cryptocurrency directly. The cryptocurrency for Bitcoin is custodied at Gemini, custodian for that fund, and Ether for the Ethereum that fund holds. And the funds are always 100% deployed. So this is a remarkable milestone and quite a good breakthrough for the ETF industry, because it means that you can get spot Bitcoin, for example, in an ETF on the stock exchange, and you're 100% deployed whether you own it for an hour, a day, a week, or a year. And that really gives you the same thing as owning Bitcoin, but from your brokerage account. And so this was a result of the build out of the infrastructure around custody, the build out of the infrastructure around pricing so that we can be sure we can deploy at our NAV price, as well as the market making liquidity providers that are in the industry so that we can always trade at our NAV price, combined with an ongoing dialogue with our regulator in Canada to give us the ability to get finally through all the questions and hurdles to launch these innovative products. And so obviously Canada is very proud to have physical crypto ETFs, and it's been a long road, but we're very excited to be here, and we think we're just beginning this journey into further cryptocurrency options for Canadian investors.
Yeah, that's a great point. That comes up a lot in discussions around, is it futures based, is it spot, especially since in the US, obviously, many people would be aware that they've approved futures based Bitcoin ETFs. And we do believe there's significant advantages for investors to own spot, and we're proud to offer those to Canadian investors in the market. So my next question is about kind of the opportunity for investors and then also financial advisors together to leverage this new category of ETF.
Yeah, so it's a great point, Kate. And really what this comes down to is, how do people invest? How do people work with their advisors to access any investment opportunity, not just cryptocurrencies, but obviously the entire investment landscape? And so the reason we were excited to bring ETFs to market was to allow investors to hold cryptocurrencies in their brokerage account, because that opens the door to working with your financial advisor to invest in cryptocurrencies within the context of your overall portfolio. So, you know, we obviously would be remiss if we didn't remind everybody on this call that cryptocurrencies are volatile, and before investing, you should speak to your financial advisor. But in having that conversation with advisors, we've heard from a lot of folks that they talk to their advisors about crypto assets, and they're not really part of the conversation because, you know, people are investing in them in a direct crypto exchange, which means they've moved money out of their advisor brokerage account into that exchange where they're investing directly. And that really takes those assets and takes that strategy away from their overall more holistic picture of their finances. And whereas by using an ETF, you can rebalance on a regular basis and you can include it in your overall strategy. Now, on this slide, we just wanted to pick a couple of data points that we saw from the US recently. This is number of clients at Coinbase, Fidelity, and Schwab. And actually, the Schwab number may be slightly overstated here because they listed as number of accounts. And so, of course, a client could have more than one account. But nonetheless, the story is quite compelling. Investors who are not using crypto ETFs are accessing cryptocurrencies directly by moving assets away from their brokerage account and to cryptocurrency exchanges. That is a trend that we have seen in the US. We see the same trend here in Canada. And we think that ETFs offer a better way for advisors and investors to work together to include access to this investment theme within their overall portfolio strategy and to meet their overall portfolio goals. And so if we move to the next slide, just as a little bit of a high level recap for those of you who have looked at our crypto ETFs and why they are, you know, something worth considering, because obviously you can buy physical crypto and you can do self-custody. You can go all the way down the rabbit hole to owning your own digital wallet and owning your own keys. And for some folks, that's a great solution because some people are very technically inclined. But for a lot of other people, they want the same simplicity and liquidity that you get out of any ETF or any exchange-traded company or exchange-traded fund. They don't want the hassle of dealing with a wallet, dealing with private keys. If you lose your keys, you've lost your Bitcoin, you can't get it back, it's over. And they also want the certainty of being able to hold it on a regulated exchange in their brokerage account, and oftentimes in tax sheltered or tax advantaged accounts like RSPs and TFSAs. That's what the ETF does. We at Evolve really take a lot of that complexity and difficulty, the challenges surrounding digital asset ownership, wrap it into an ETF, and then you can buy it on the Toronto Stock Exchange just as you would any other ETF. And we think this is a huge opportunity and advantage for investors who are looking to invest in this asset class without having to go up the technical learning curve of doing it themselves with their own keys and their own wallet.
Yeah, those are all great points. One other thing I'd add around portfolio construction, because we do get asked that a lot. There's a great stat out there that one of the largest RIAs in the US actually the way that he thinks about crypto in his client's portfolio is he'll add in a small sleeve, 1 to 3% across all clients, because if the asset class drops by 50%, it's a small part of your portfolio. It doesn't make too much of an impact. But if it goes up quite substantially, which it has in the past, it could start to become a meaningful part of your portfolio. So it's an interesting way of thinking about how this type of new asset class could work into your portfolio. So now I thought we would take a step back and go back to some of the basics around both Bitcoin and Ether, and then touch on some recent updates as well. So we'll start with Bitcoin, but Elliot, at a very high level, could you please give us a little bit more information on what the problem is that Bitcoin is trying to solve?
Yeah, for sure. And this is a problem that I think people don't think about very often until they need to. And so if we zoom all the way out and think about money, which is something, again, if you're in a currency like the Canadian dollar, you might not think about the value of your money very often. Although these days, with inflation being what it is, more and more people are realizing that their money isn't worth what it used to be worth. So then it kind of opens up the question, well, why not, and how does that work? And so going all the way back thousands of years ago, and this is obviously highly summarized, societies used all kinds of things for money, shells and stones, and eventually settled on gold. And gold became widely accepted for a very long time because it's got scarce supply. It's got a very high stock to flow, meaning there's a lot more available than there is new gold coming into the system because it's so hard to mine gold. You can't create it out of anything else, so it's very hard to debase. And this became effectively the framework for hard money. Now, the problem with gold is that it's very, very low velocity, right? If I have a bar of gold or a bunch of gold coins, it's really difficult for me to transfer them to other people. I have to carry them around. They're heavy, they're difficult to secure and protect, and they're very difficult to divide and recombine. And that's maybe one of the bigger issues around the velocity of gold, is that it's very difficult to chop a gold bar apart into smaller amounts and then melt it all back together again, although of course it is possible. And so what happened was banks, originally individual banks and then regional banks and then eventually central banks, decided, well, why don't we hold all the gold and we'll issue debt on top of it. We'll issue an IOU and you can use that. And that became paper money. And so governments issued money on top of physical gold, and this was essentially a debt obligation, IOU this much gold, and people could then exchange those dollars, as they came to be called, and that worked fine. And it was a paper money on top of a hard asset, and for quite a long time that actually was the sort of framework for currency in the world, and really until World War I. And you saw the cracks in this system happen during World War I. The UK confiscated private gold holdings because they needed to pay for the war. They were effectively bankrupt. All of Europe ended up coming off the gold standard after World War I. The UK struggled to get back on it, suffered a terrible recession in doing so. But essentially, power in the world shifted to the US at the end of World War I because they were bankrupt. But they broke the gold standard in Europe in order to deal with the costs of that war. When the Great Depression hit in 1934, FDR issued an executive order to confiscate private gold in order to facilitate the ability for the Federal Reserve to print money to try to stimulate the economy out of the recession. But you could already see what's happening here. When the economy itself was not generating value, the government thought, well, we can relieve the burdens on the economy by just making more money. But I think, these days, as I'm sure everybody's more and more painfully aware, increasing the money supply does not have a long-term positive effect for the economy. In the short term, perhaps you can solve some very acute problems, but in the long term, you end up making money less valuable, and those who hold money are less wealthy. Now, there was the Second World War, and after that, the major world leaders got together and said, well, it would be really nice to get back on the gold standard because we had prosperity for hundreds of years when we were on the gold standard. And so they came up with this scheme called the Bretton Woods Agreement, where the US dollar would be backed by gold, redeemable by other world currencies, and the other countries would back their currencies with the US dollar. And this became the dollar standard. Some people call it the petrodollar system because it facilitated the transaction of oil, which is, of course, the world energy input. And for quite a while that worked until, once again, there was another war and the US became bankrupt effectively. And Richard Nixon closed the gold window in 1971 in August, and that brought the entire world off the gold standard. Since then, the world has been on what is termed fiat money, meaning the money exists only because governments say so, and effectively it's proof of force, to take a crypto term. People can only have to use that money because they're forced to by their governments. So this can be okay for a while if you're in a stable country where other things are going well. But anybody who's been to emerging markets like Venezuela or Zimbabwe and seen what happens when the currency is really destroyed through bad public policy understands that this can, at some point, perhaps get to be quite bad. Now, I'm not arguing that we're there in Canada at the moment by any means, but we certainly do have higher inflation than we've seen before. And the macro backdrop today in the world is a much more difficult place than it was even a few years ago. We've got geopolitical risk. The list seems to get longer every few months. War in Europe. There are sanctions against Russia. There's COVID. And there are anti-lockdown protests around the world as people are trying to get back to a normal form of life. In response to some of these risks, we've seen governments who control the financial system using it to enforce their will. In Canada, the federal government froze the bank accounts of protesters. Russia is no longer a part of the SWIFT network. There are sanctions on Russian payments. And the US froze Russian assets and Afghan assets as a result of the turmoil that they faced with those countries. And that really was the moment where a lot of countries around the world said, you know what, the US Treasury is no longer risk-free. It's not a risk-free asset like they say it is in the textbooks, because it has confiscation risk. If you are not politically aligned with the US government may take your money. And since some of those sanctions have come into place, we've seen oil from Saudi Arabia denominated in Chinese yuan, for instance. We've seen Russia, for example, saying that they're willing to accept Bitcoin as payment for natural gas. And people are searching around for a new currency because the US dollar is losing its position as the global settlement currency. Now, add to that inflation, add to that the Federal Reserve policy of raising interest rates, and the same here for the Bank of Canada. That language and guidance started back in November. That's caused the stock market to tumble since, and a lot more volatility in equities that we've all seen. And all of this is in the context of the end of a 40-year credit super cycle, where the developed world has printed more money to bail out the system several times over when there have been crises like the dot-com bust or the global financial crisis, and now the problems that we see today. And the problem, in a nutshell, is you can't really raise interest rates when you have 4 times as much debt as you have GDP, because the debt load itself prevents that from happening. So certainly we don't anticipate that the Fed goes to double-digit interest rates like they did to solve inflation back in the 1980s. And then the question, of course, is, well, what happens? So we have a few charts on this. I'm sure what I'm describing here is being better articulated by a lot of other people out there commenting on the markets. But needless to say, sometimes a picture is worth 1,000 words, and we can see here that inflation is at 40-year highs. And despite what they might say, we've seen 6 months of 40-year high prints in inflation in the US, happening before the outbreak of war in Europe, and really much more to do with the monetary side of inflation. The bull market in bonds is over. You've seen outflows in bond ETFs. I believe global ag bonds year to date are down greater than 10%. And we've seen an inversion of the US yield curve, which means that the bond market in the US is forecasting a possible recession. So this is all fairly alarming macro data points. And it's an important backdrop for Bitcoin, because Bitcoin is all about finding a solution to these problems. So Kate, if we could go forward a couple of slides to what investors are looking for as a solution here.
I'll just interrupt you there quickly.
Oh,
I think that was a great overview, going back to the history of what is money and the transition from kind of a commodity money to fiat money to now where we are potentially in this idea of digital money. So my next question, now that we have kind of that macro backdrop and what's different today, is from an investor's perspective, why is Bitcoin specifically the solution? So what are the characteristics of Bitcoin that make it the ideal store of value, et cetera, going forward?
Yeah, so we would have this question whether Bitcoin existed or not. And a lot of people say, you know, if it wasn't for Bitcoin, we'd see much higher gold prices today. But because there's another solution, we're actually seeing gold hasn't moved as rapidly since the outbreak of war in Europe as was expected by a whole bunch of people. So let's go back to first principles. What do investors want, or what do you want for the money that you're trying to save and store for the future or pass on to your kids? Well, you want it to hold its value. You don't want to have cash that is going to lose a third of its value every year. That really is the same thing as, you know, inflation protection. But further than that, you want growth. You want some kind of ability to increase your wealth and a safe haven when there's uncertainty in the world. Now, all of that, I think you could achieve to some extent with gold, but gold continues to have the problems that we talked about up front in terms of its low velocity problem, and you know, it's very difficult to use. And these days we live in a digital age. I mean, ignoring digital currencies directly for a moment, I haven't paid with paper money for years. Even a few years before the pandemic, I was always tapping my phone or tapping my card. So you need something that you can use digitally, whether it's digitally at a point of sale terminal or digitally online. And you want an asset class where, as there's more adoption, the asset class improves. So those are things that we see as characteristics when you think about Bitcoin. And so if we could go to the next slide, it's the combination of these two properties that gives cryptocurrencies their value. Bitcoin in particular, Ethereum has some of these values, but other opportunities that we'll get to a little bit later. But it's the scarcity. There will only ever be 21 million Bitcoin. 19 million have been mined so far to date. It's going to take 140 years to do the rest. Every 4 years, the amount that gets mined in a block drops in half, which means that we're going to be at something like 99% of all available Bitcoin will be mined by 2025. That is effectively zero inflation from the standpoint of anybody holding Bitcoin for the remainder of their lifetime. And really, it's not 19 million because it's believed that about 4 or 5 million were lost early on. So you're looking at a $14-15 million total supply that is available. But because it is infinitely divisible, which is, again, a massive advantage over anything else, including regular, I mean, our Canadian dollar can be divided into 100 pieces, not infinitely, and gold is much more difficult to divide. Because it's infinitely divisible, there's enough for everybody. You can actually increase the number of people participating in this network without diluting the people who are already there. And this is essentially a unique property that crypto assets have that you don't see out of things like shares in a company, you don't see it out of cash or anything else. And so adoption is the other element of the value generation. Network effects are something that we think about in a huge amount that evolve as we look at our disruptive innovation categories that we're investing in, because network effects drive value. There's something called Metcalfe's law that says the value of a network is a function of how many nodes are on the network. Imagine 2 telephones. They're not that useful. One person can talk to another. It's way more useful if you buy a telephone and everybody else in the world has one, because now your telephone is as valuable as the rest of the network. And we've seen this time and again, driving value for companies that are built around network effects. Facebook and Twitter, the most obvious sort of digital examples of that. But even things like the iPhone. iPhone obviously became valuable up front because it was a telephone. There were lots of telephones, but the value of the app ecosystem within iPhone became much more valuable as more and more people got apps, because then you could share things within apps and so forth. And I think we have a slide on adoption curves as well that show the speed as well of this change.
Yeah, and because I was going to say, I just wanted to interrupt quickly and say that this all sounds great. So it sounds like these network effects are working. And then I thought in the next slide, we'll touch on a little bit where we are on the adoption curve. So I'll just go to that slide and can touch on it briefly.
Yeah, this is a little challenging to read, but essentially you've got an increasing speed of network effects as you go further over to the right of the slide, and Bitcoin and Ether at the far right side here. But things like mobile phones that you saw there had a very vertical kind of adoption curve. So the adoption curve is the kind of, this is how many people are adopting it, and then you can see a lot of these things flatten out once you hit saturation, right? So such as televisions flatten out in the middle of the chart there. As you can see early on, railroad miles took a long time to adopt because it was really difficult work to lay new railway track. Digital assets have essentially zero friction to use. I mean, the most difficult thing about buying a cryptocurrency directly would be essentially the wire transfer and setting up the account at the exchange. Now, of course, our ETFs help make that a lot easier for people. So the number of people getting involved is skyrocketing. I heard a stat recently at a Bitcoin conference that if Bitcoin was a nation, it would be a nation of 140 million people. Now, I think that understates it because it doesn't include people who own Bitcoin through things like our ETF. But it gives you an idea of how rapidly it's grown in the 10 years since it came into existence, as well as how early we are, because the addressable market for the globe is obviously billions. The addressable market for the internet is billions. We're nowhere near as many people owning Bitcoin as currently have Facebook accounts, for example. So this is just a little bit of context around the speed of adoption and how fast this entire trend is moving.
Yeah, and in the US, we've read a stat before that currently is about 25% of Americans that have invested in crypto in some way. I think back in 2017, that number was closer to 10. So that to that point, we're really moving quickly along that adoption curve. But nonetheless, we're still early in this new technology as well. So now I thought we could switch gears a little bit. It sounds like there's lots of opportunity in this space. And that's one of the reasons why we're so excited about it. But there also are a lot of challenges for investors to add it to their portfolios, to start using Bitcoin more frequently. And that kind of is around volatility, equity market correlation. Those are some of the big objections we often get from investors. So I was wondering if you could touch a little bit on those and how that's impacted potentially the adoption of Bitcoin specifically.
Yeah, absolutely. So volatility is the single biggest barrier to the adoption of crypto assets. I mean, you could argue it's also one of the great allures of crypto assets because when prices are going up, everybody gets very excited. But it keeps out investors who don't like volatility ultimately, and that tends to oftentimes in these cases be possibly large institutions. As is true with any emerging technology, volatility will drop as adoption increases because your install base gets to be so much bigger that anybody's individual decision to buy or sell Bitcoin is diluted by a larger pool. And then when groups move together, they're not going to move together versus the overall pool in the same way. And so volatility drops. And we are really nowhere near the kind of saturation in crypto assets, Bitcoin in particular here for this slide, that you see in something like equities or large cap equities. So in a lot of ways, the way I hear a lot of people think about the volatility in Bitcoin is it's almost like a venture capital stake in most venture investments because they are privately held by large VC angel investors and institutions. And by the time it gets to the public market for retail, a lot of that volatility is already passed. Well, this is flipped on its head because the institutions are going to be the last ones in to crypto assets. The retailer investors are in first, and the volatility effectively is an opportunity. Recently, we've seen a lot of people say, Bitcoin is just a tech stock. Look at how correlated it is to the NASDAQ. So we decided to put a NASDAQ correlation on this chart. First of all, it's not super correlated to NASDAQ. Even at its most recent height of correlation, you see it as a 0.53 correlation. And you can see this goes back 3.5 years. And in some cases, it's negatively correlated. The level of correlation has changed dramatically over time. Generally speaking, Bitcoin becomes more correlated to tech stocks during periods where it is going sideways in price or it's range bound in its price, and that correlation falls apart on an upward rally within the price of Bitcoin. And so a lot is often made of this because people look at the last 30 days and say, oh, 30 days, it was correlated, the game is over. We don't think that's true at all, but we do think that it presents a challenge for the narrative. And I think the narrative around Bitcoin is still being developed, and I think not often always told in the best possible way.
Mm-hmm, mm-hmm. So yeah, so it sounds like volatility is obviously keeping people away from thinking of this asset as more of a safe haven asset class, kind of like people do think about gold. So I was wondering if you could comment a little bit on how Bitcoin has done since the war in Europe specifically.
Yeah, so let's have a look at some returns since war broke out in Europe. So that February 24th, the Russian forces invaded Ukraine, and in the first 24 hours, there was a fairly big sell-off of risk assets, and there was a weekend as well. And so, crypto assets trade 24/7, and so you can actually get pricing in a way you don't for the stock market. It has these long breathers overnight and weekends and so forth. And some people were looking at those after the first 24 hours saying, oh, this isn't a store of value. But actually, over the days that followed and the weeks and now over a month since, what we see is that Bitcoin and Ether have actually been a much better store of value than gold, which is, was originally the flight to safety. But gold is essentially flat since the war invaded in Europe, which I guess you could argue is a store of value, but it is down small, about 1%. Investment grade bonds have been a disaster. Equities have sold off as well, and that's the S&P 500. If you put NASDAQ on here, you'd see even more damage. And so what you have here is a situation where crypto assets have provided a better experience for investors. Now, there may be a variety of reasons for this that are related to the conflict in Europe. We've certainly seen crypto assets used by both sides of that war. Over $100 million worth of Bitcoin and Ether was raised by Ukraine to buy weapons. And then there's been discussion by Russia of accepting Bitcoin as a means of payment. And that really just says more than anything else that there's no morality in these digital bearer assets like Bitcoin. Anybody can use them. And they are therefore perhaps more attractive in times where people are concerned about whether or not their financial assets will remain safe. That being said, there's been a lot of conversation around whether or not Bitcoin is allowing Russia to evade sanctions and things like that. And there's certainly no evidence that that's the case. But we do see an increased interest in the adoption of digital assets during this time of uncertainty, which we believe is a shift in investor mindset around what a safe haven actually means today in our digital world. And we think that we certainly agree with the narrative that if Bitcoin didn't exist, we think gold would have done much better over the past several weeks than it has. But we think that this is an important element of recent price behavior that indicates that there's a shift in sentiment around crypto assets in terms of that use case.
Mm-hmm. Great. So my next question is around, it's a question we get often actually, and it's around have we missed this trade? So Bitcoin, as you would have seen in the last chart, has performed historically very well. More recently, as you can see on this slide, it's been trading in a little bit more of a consolidation range. So my question is, what do you think the size of this opportunity is for investors?
Yeah, so volatility continues to be, a concern for everybody, but this opportunity size, I think this slide kind of tells a story. We call it our solar system slide. The dot you can almost barely see is Ethereum. Bitcoin's a little bigger, and then it's nowhere near the size of gold, let alone global equities. So this, to us, is the data that tells the story that you hear if you speak to lots of investors, that the institutions are not here yet, that this is a retail story, and it's still very early. And so you don't necessarily have to accept that Bitcoin or Ether take over the world to have a sense that they have a lot of opportunity in front of them to grow, both on an absolute and a relative basis. I would add another comment to this around Bitcoin supply. One of the great things about a blockchain-based asset is that you can look on the blockchain and look at things like which wallets hold which coins, when did they last trade, are there wallets that only ever buy and never sell? Those are kind of viewed as long-term holders. Are there any wallets that trade all the time? Those are short-term holders. You don't get any of this information when you look at the equity markets. You get price and volume, and that's it. You have very little transparency. There's an enormous amount of transparency, and there are companies like Glassnode that analyze the blockchain and have set up a brand new field called on-chain analytics. The main thing to see from this slide, the orange bars are the supply of Bitcoin that last moved over a year ago. And what you see is it's at all-time highs and has been growing through this consolidation period. That's pretty significant because it means that the folks who have been investing in Bitcoin for the longest are the ones that have been buying this dip. And these are folks who have very little history of selling. So they're likely to hold on and not get, whipsawed out by a price move, a sharp price move. And so we think that this is a particularly interesting data point to have a look at.
Great. So now we're going to shift gears a little bit. You were recently at Bitcoin Miami, which is one of the largest Bitcoin conference in the world. I don't know anyone on the line, they must probably saw a picture of this bull. It kind of took over social media for that weekend. But I was wondering if you could touch on maybe what you think the key announcement was at the conference. Obviously, there was lots of great stuff covered, but what is the one thing that investors should have taken away from Bitcoin Miami?
Yeah, so first of all, for anybody who attended, you could see it was so big they had to move it to the Miami Convention Center, which also, is where they have put that bull statue, which is pretty exciting and pretty fun. They had to move it to the Miami Convention Center because it's 25,000 people this year. That's more than double the previous year, and much more than it was in previous years before that. The story of the conference is adoption. You saw it just walking around in such a crowded place, and all the people from all walks of life and all sorts of different industries talking about Bitcoin. But the one announcement, the one speech, and I would really encourage everybody to go on YouTube and find the Jack Mallers keynote from Bitcoin 2020 and watch it. It was an unbelievable presentation. It was a pretty exciting room to be in at the time. Jack Mallers is the CEO of a company called Strike. Strike is a Lightning wallet payments app. And Jack Mallers in 2021 led the announcement of El Salvador's adoption of Bitcoin. And Strike has put El Salvador onto the Lightning Network so they can use Bitcoin as legal tender. And it is now indeed legal tender in El Salvador for all payments. You can use Bitcoin and they use it on Lightning. Now, Lightning, for those of you who don't know the technical details, is a layer 2 on top of Bitcoin that is Bitcoin, still on the Bitcoin network, but allows you to send Bitcoin in small amounts. So you could send enough Bitcoin through Lightning to buy a cup of coffee, for example. And it's instant and it's free. And so this is the key to unlocking really that velocity of money that we're talking about as it relates to Bitcoin. Bitcoin itself is great. You get a new block every 10 minutes like clockwork, and you can transfer as much as you want in a new block. You can transfer billions of dollars in a new block for 20 cents. But Lightning is the key part of this. And what Strike has done is they announced a partnership with Shopify, the big website payments company, as well as NCR and Blackhawk point of sale terminals, which covers about half of US retailers. And by the end of the year, you will be able to pay with Bitcoin at half of the US retailers, as well as many, many of the online shopping destinations on the internet. That is an enormous step forward in adoption and really puts to rest the criticism of, well, Bitcoin's nice, but I can't use it for anything. That is no longer true. So if you live your life on the Bitcoin standard, if you get paid in Bitcoin, you can shop in Bitcoin. And we think that this is a really remarkable announcement that will go down as kind of one of the big elements and big events in the history of Bitcoin as people look back.
Mm-hmm. Awesome. So now I thought we would switch gears to Ethereum. We all know that there are very different use cases for Bitcoin and Ether. So I thought maybe we could just quickly go over high level what is Ethereum, and then we can touch a little bit on how it's different than Bitcoin specifically.
Sure. So Ethereum is it's a project that was inspired by Bitcoin. The developers of Ethereum said, well, Bitcoin's interesting, but it just does one thing. It just stores value. It's just a ledger of who owns the Bitcoin. What if we made the ledger programmable? So you could actually write code that executes within that blockchain and you could build other things. In a nutshell, that's it. Shares a lot of the same properties as Bitcoin. Fully decentralized, it's global, it's 24/7, and it's gaining adoption. But Ethereum, because it has larger ambitions, also has some challenges that I think we can get into, Kate, in terms of some of the upgrades that we've seen and some of the upgrades that we need to move forward within Ethereum. But in a nutshell, essentially, Ethereum is a programmable form of Bitcoin. Digital finance is being built on top of it. If you hear terms like DeFi, if you hear about NFTs, those are all things happening on Ethereum. And so the Ethereum story is vastly larger than the Bitcoin story, and often thought of, therefore, by investors as being more of a venture capital kind of angle than just a store of value kind of angle.
Yeah, and the venture capital angle is a good way to think about it, because when you're investing in Ether, the token, you're investing in the growth of all these projects that are built on top of the Ethereum blockchain, which I think is a good way to think about it as well. So, and this segues well into my next question. You mentioned it a little bit. Ethereum is currently undergoing an upgrade right now to the network, referred to as the merge. So I was wondering if you could walk us through a little bit about what is the merge, first of all, and then how is it relevant to both users of the network and then also investors?
Yeah, for sure. So let's talk about what it means for users. So some of the Ethereum has gained in popularity so incredibly quickly that it's become essentially congested. As a result, it's quite expensive to do things on Ethereum. Right now, I think a transaction costs about $80, which is obviously vastly more than Bitcoin's 20 cents or Lightning, which is free. So you're looking at a much bigger amount of money just to use the system. So they need more block space. Ethereum needs to scale up. As part of that ambition and other improvements to the network, we saw two upgrades last year, the London upgrade and the Berlin upgrade, that laid the technical framework for something coming up in the first half of this year called the merge. In the merge, they're trying to merge in a new version of Ethereum with the existing Ethereum and then create a new version of the network that has much, much greater scalability and also changes how it does mining. So you may have heard of cryptocurrency mining, Bitcoin mining, and so forth, and something called proof of work. That's where your computer has to solve a very, very difficult problem to participate in creating the next block. And that means that people who want to mine Bitcoin, for example, have to invest all the time in new hardware, which is expensive and challenging to maintain and costs a lot of heat and other things. Ethereum is moving to something called proof of stake. With proof of stake, anybody who is willing to stake some ETH that they buy would be able to be a validator on the network with consumer level PC hardware. And that allows the network to become more decentralized, have lower energy consumption, and much more democratic in terms of participating as a validator on the network. And just like a miner, if you're part of the validation and you validate with a pool of other validators, you're going to get paid for it. You're going to get some of the ETH that comes from what's called the block reward. When a new block is made, some of the people who participate in that get some of that ETH. So this is a big deal. It's a big deal because the scalability is going to increase. The speed and cost of using Ethereum is going to increase. It's merging in this new technology with the old one, and that's why it's called the merge. Now, some people have said, well, what if the merge doesn't happen? Like technical projects get delayed all the time. And one of the things we look at is, well, okay, but how many people are betting that it will? And the new version of Ethereum already has $30 billion staked by people who want to become validators. There are 350,000 validators in that new network. This thing has absolutely reached scale. It's just a matter of now going through the process of the steps to merge the two together, and the scalability is going to happen. And last year, those two big upgrades really gave confidence to everybody in the market that the merge will happen and will indeed, be good for, therefore, all the people using Ethereum. And so we really think that these upgrades are going to cause Ethereum to increase in popularity after the merge is over, because instead of somebody saying, well, I don't want to pay $80 to play with NFTs, they're going to say, oh, it's effectively free or very cheap, and I'm going to start to use more and more DeFi apps.
And I think that transitions nicely to what that means for investors as well. So I know we talk about ETH being a triple point asset. So maybe Elliot, you can touch a little bit on that as well.
Yeah, so this is an interesting thing, and it may be that Ethereum becomes something that we've never seen with any asset in history. I certainly haven't heard any examples. People are calling ETH a triple point asset. So with the upgrade last year in the summer, ETH became its inflation rate dropped, and in some cases started to become negative, and that's because they implemented something where new blocks where there's mining fees paid to miners, some of those fees are deleted from the network, reducing the amount of ETH outstanding. That means ETH becomes a scarce store of value, much like Bitcoin. So you have a store of value element. Because you can stake your ETH and validate on the network, and get paid for that validation, you earn a yield. So now you have a yield-bearing store of value. You know, we go back to the example of gold. Gold is great, but gold does not offer a yield. And investors a lot of times say, I don't want gold because I need a yield. In this case, you have those two. And then the third is the commodity element, where ETH itself is used as the gas for powering this network. And so a store of value yield-bearing commodity, as far as I'm aware, is unique. And one of the reasons why people are so excited about ETH as an investment, even if they're not currently users of the Ethereum network today.
Great. So now moving on, and we've alluded to it a couple times in the presentation already, about the Ethereum network being a building block for DeFi or decentralized finance. But I thought it would be good to give a little bit of an overview and some specific examples of some DeFi applications.
Yeah, for sure. The DeFi ecosystem is exploding in size, and so we could do an entire webinar just on DeFi, and you could spend hours and hours every day looking into it. We've tried to break down the current state of DeFi into 4 high-level categories and give a few examples here. So first of all, there's the credit market. You're seeing this increasingly growing in size. One of the apps on Ethereum is called Compound, where you can borrow money on a peer-to-peer basis. So for example, Kate might take some ETH and stake it in Compound because she wants to earn the interest that I would pay if I borrow that ETH. And the Compound system allows that lending and borrowing to be done through a smart contract that's programmed into the blockchain with various triggers that would cause my collateral, I'd have to post some collateral, to maybe be swept out if I don't make my payments, for example. These are all things that happen today in the banking system. If you post your house as collateral and take out a mortgage and you don't pay your mortgage payment, the house is taken by the bank. But it's a very slow-moving process in the world today. And on the blockchain, it can be fully automated and trustless because the network itself secures it. So I don't need to trust that I know how to find the counterparty in order to get paid. Foreign exchange actually might be the biggest thing that's happening in DeFi in terms of the number of different digital exchanges you can use to exchange various different digital currencies. Now, in the beginning, people would say, well, why would I want to do that? That's just me playing with multiple cryptos. Why is that relevant? It's becoming increasingly relevant with the advent of stablecoins. And stablecoins might be one of the most significant apps on DeFi if you think about that category of cryptocurrencies living within DEXs like Uniswap, where people can buy and sell them. For example, recently we've seen enormous inflation in Turkey. I believe the official headline inflation rate of Turkey is over 100% at the moment. And people who live there are actually using a stablecoin called Tether, which is tethered to the US dollar, as a way to use a currency within their economy that is stable because it's tied back to the US dollar. They couldn't use real US dollars because the banks don't have real US dollars, but they went to stable coins. And so as we go through, again, more turns around financial turmoil in the world and currency turmoil in the world, stable coins along with crypto assets may become part of the solution that people turn to. You've got derivatives on here as well. Synthetics is a place where derivatives are traded on DeFi. I saw recently some news. It was a weekend where there was yet another Elon Musk tweet that affected Tesla. And in the news, the journalist, I believe it was a Bloomberg story, was looking at the price of Tesla's synthetic tracking token on synthetics on a Sunday to get a sense of how the market was reacting to the Tesla news. So this is an example of digital assets providing that element of improvement to traditional assets because you now have a 24/7 market that's fully global. And then maybe the most famous form of DeFi app and DeFi use is the NFT. It's taken over the world in terms of news because you've got things like an artist named Beeple sold an NFT for almost $70 million last year. NFTs are being used as a way to trade elements within games. Epic Games Fortnite, for example, has got NFT components to trading the things that you might buy in the games. The NBA now allows you to buy your favorite basketball player's shot from the game that you were at in NFT form. So you would own that shot; it would belong to you in terms of its long-term ownership. And so I think the fun element of the NFT, I'll trade interesting looking cartoon characters and so on, has really opened the door for more people to participate in DeFi as well. You've pulled up the slide here, Kate, of the growth of DeFi. We keep a close eye on what's called total value locked. That means how much money is staked in these protocols, how many people have invested in something or bought something from a DeFi project, and therefore their money is locked in there. Right now it's about 75 billion. There's some projections here about growth. There's an expectation that the blockchain technology industry is going to grow to over 70 billion in 2026. That's separate from the total value locked. That's the companies who are building on top of DeFi. I heard a stat that there are more developers working on DeFi projects than there ever were working on the Linux operating system and various different pieces of software related to that. And as we all know, that's taken over, the entire infrastructure of the internet. But it's a massive, massive ecosystem. I believe if we could switch to the ecosystem slide here, just shows you that the number of categories you can slice and dice them into other ways. There are so many companies, projects, and so forth investing in them. And a lot of these projects are backed by really big VCs as well. So technology-focused VCs like Andreessen Horowitz does a lot of investing in companies building on DeFi. So does Gemini Ventures, that the Winklevoss brothers have as their VC business as well. So these are well-backed projects with real developers who have projects that are up and running and getting increased use, and they're improving all the time. So it's a huge growing element of the crypto market, but also technology in general.
Mm-hmm. Great. Awesome. Well, thank you so much. So I think now, we do actually have lots of questions coming in, so I will get to those. First, I do want to just kind of close out a little bit and give all of our listeners a reminder of our products and how they work again. So quickly, as we did mention at the beginning of the webinar, I do just want to bring up once more that when you purchase our products, either our Bitcoin, which is EBIT, Ether, ETF, or ETC, the one that combines both, you are purchasing physical Bitcoin. So that's very different than in the US when you're buying a futures-based product. As everyone knows probably on this call, futures do have large roll costs, and they don't always properly track assets. But when you're purchasing our crypto ETFs, you are, as Elliots mentioned and I mentioned as well, you're 100% deployed. So if you invest $100 in EBIT today or tomorrow, you will own $100 of Bitcoin. So you can kind of think of it almost as a digital wallet in your brokerage account. Here you can see kind of some of our best-in-class service providers. So our index provider is CF Benchmarks, our sub-custodian is Gemini as an example. And this is just the one slide again on our three products. I do also like to point out our USD classes. Not everyone is always aware that you can purchase both or all three, Bitcoin or EBIT, Ether, and ETC in USD as well. So with that, I think I'll ask a couple of the questions here. So one of the questions here, Elliot, is what is Elliot's thought on hodling and the impact for adoption?
I love this question because it goes to the heart of the benefit of Bitcoin. Let's just use Bitcoin as the example of being infinitely divisible. If you imagine a stock, say a public equity where there's only so many shares outstanding, it's really a zero-sum game. For me to buy 100 shares, somebody else has to sell 100 shares. There are only so many shares. And you see the number of shares outstanding grow. Oftentimes, company will do stock splits because they want the number of shares available to grow so more individuals can buy them. That's not true for an asset base that's infinitely divisible. You don't need to increase the number of sellers for there to be a commensurate increase in the number of buyers. And it's very important for price, right? If I have some Bitcoin and I have no intention of selling, I'm going to pass it along to my grandchildren, so I'm going to hold it for decades. That doesn't stop new people from coming into the network and participating. You obviously need somebody to sell, but there are buyers and sellers every day. It's a very liquid market. If the number of new buyers becomes a huge wave of new buyers, and if they want to deploy very large amounts of money, it's going to, the price will go up, but I don't have to give up any of my coins, and I am not diluted. That's the key thing about an infinitely divisible with a fixed supply, or 19 million going to 21 maximum, which in the case of Bitcoin. So I think what you're seeing, and the reason why we saw that tight supply dynamic relating to Bitcoin, that slide showing that you've got more long-term holders than ever before, is that you're seeing Bitcoin adoption increase and the adoption of long-term holders increase in terms of number of people holding. And it doesn't matter that the supply won't increase, because you can just continue to divide it all up, which means, it's sort of an interesting concept. We will never run out of Bitcoin, even if almost all the Bitcoin is not being sold. And so anyway, it's a great question. It really goes to the dynamics of what, and when you think back to those adoption curves, you can see just how explosive that recipe could be when combined together. Long-term holders who won't sell, combined with a large number of new adoption into the network.
So a second question we have here is, Elliot, is there a bear market on Bitcoin every 4 years, and why?
Yeah, so that's certainly, if you look back at the Bitcoin chart going back to 2013, you do see this cycle where there has been a large run up in certain phases of the cycle, a bear market, a consolidation period, a large run up, a blow off top, and then another bear market. And the timing of that being 4 years has to do with this property of the Bitcoin network, where every 4 years, the amount of Bitcoin that is issued in the block reward, meaning the miners who create the new block, they get a certain amount of Bitcoin. Right now, it's 6.5 Bitcoin. It gets chopped in half every 4 years. So it was 13 Bitcoin a few years ago, and then it was cut in half. That 4-year halving cycle has caused there to be a bit of a dynamic in terms of price running up in anticipation of it. It gets overheated and price drops. The other thing to bear in mind is that the volatility in the market is partly a function of the fact that it's still such a new technology. People who are buying it are, they're buying it or they're selling it, and they don't have other ways in which they can get exposure. That's changing now with more derivative products in the system, with ETFs providing people to have access that don't have to come and go from their account and so forth. We have seen the 4-year cycle break down. We saw it break down last year. Last year, we had 250% drawdowns, and we have not gone through a full 4-year period since the last halving of the block reward. And that, I think, is to be expected as adoption increases. It's sort of, it's basically mathematically impossible for you to get an increase in adoption and maintain the same level of volatility on the same cycle, because you just have more people participating in the system who have different timelines and different views. And so somebody who bought Bitcoin back in 2017 has a different emotional reaction to the price of Bitcoin than somebody who bought Bitcoin last May. And so we're seeing volatility drop. We're seeing the cycle change. I think it's now fairly widely accepted that the 4-year cycle has broken down. But the reason it was 4 years was because of this cutting down of the block reward every 4 years. And it is pretty much on schedule. There's a new block every 10 minutes, and every 4 years, it actually is on the number of blocks, but it turns out to be every 4 years they cut it. It cuts in half.
Great. So I'm looking at the time. We do have maybe just one more question. It's come up a couple times, it looks like. The question is, can you comment on the reduction of Bitcoin to long-term holders? We did have a slide there showing that long-term holders are actually accumulating their Bitcoin, especially since the most recent correction. But do you want to just touch on that once more, Elliot, and then we can close out the webinar, because I know we've taken up more time than we planned.
Yeah, so again, I'd recommend people go to Glassnode. There are also some great on-chain analysts who write for Bitcoin Magazine, for example, and other publications. There's a lot of information out there, people looking at long and short-term holders. We have seen long-term holders buying on a net basis since the end of the first 50% drawdown in the middle of last year, and now they're back at all-time highs. Some of these analytics are getting more challenging because people have maybe multiple different wallets that they're splitting between. Typically, if you look at the Glassnode information, they're trying to back out known whales. For example, our ETF is kind of backed out because it's known to be a large pool of other investors. The same for things like, you know, big pools of capital like MicroStrategy, the company in the US, and stuff like that. But I would say, yeah, there's been an increase in long-term holders. One of the interesting things when you look at that data is you don't become a long-term holder when you start buying Bitcoin. You can only graduate to be a long-term holder after a year. And we're seeing increasingly year-old coins graduating into that cohort, which means increasingly you've got people who were new to Bitcoin sometime last year when the ETFs launched that are now becoming long-term holders. And that's an interesting thing to observe, and an exciting thing for the community of people involved in Bitcoin to see more people participating and seeing the long-term relevance of this asset class.
Great. So I did see one question about risk rating. So these ETFs are risk rated high, just so that you are aware. The final slide here, we have tons of information on our website, so please feel free to go to our website if any questions do come up. We've got lots of great information. Here are a couple email addresses. If you do have any other questions that we didn't get to, you can reach out to Elliot directly, or we have a general Evolve ETFs inbox as well, which we will be happy to answer any questions on any of our products. So with that, thank you so much, and I appreciate everyone taking the time today.